spending money to be advised, which is a good thing, because both parties are now invested. And two, they know that there's somebody there to manage mutual expectations, because at the end of the day, that's what you're trying to do. You're trying to manage mutual expectations between the buyer and the seller to come up with a price and terms that are acceptable to both parties. So I think the real key is put the right team together. We talked earlier about being prepared. The process of having the confidentiality in place early on is critical, because the biggest risk you have is a breach of confidentiality that impacts your customers, impacts your vendors, or impacts your employees. And again, that's another reason why to keep it out of your office and allow a third party to be involved, because then there is much, much less risk of confidentiality breaches.
Yeah, and I think you risk that run on the bank sort of syndrome with your customers if too much gets out.
Can I add just one comment to what Steve said? Some of the most frustrating and inefficient transactions are when one of the parties does not have advisors or does not have good advisors on their side. It's really the most effective and efficient when both parties have good, solid advisors, accountants, tax people, M&A people, attorneys, because they can get things done, and you're not just explaining things or trying to help the buyer or seller understand what's going on. So it's really helpful that you'd think that you would want, okay, we want good advisors on our side, we want bad advisors on the other side. But you don't. You want good advisors on both sides of the transaction to make it really work well.
A good team will help you increase the value of your transaction. Now, I can't put a number on that, but I think those of you in the room that have done deals would recognize that having good advisors on both sides will absolutely increase the value of the transaction and reduce the time it takes to get it done. Jack?
Plus, from an advisor standpoint, I would think the person would want to hire those who are familiar with their business, whether it's insurance or golf courses or manufacturing or whatever. Is that important? I mean, when they come to you, they ask you if you had experience in the area that which you're involved. Does that make sense?
Absolutely. There are certainly industry specialists, especially in financial services and in other professional arenas. You know, it's a little bit of a dual edge. If you go to a financial industry specialist, the tendency is for them to, if they're representing you as the seller, to go to who they think will buy it and maybe make the process a little bit easier. If you go to somebody that understands the process, you're the expert in the business, that team's pretty hard to beat, and then you try to cover the full waterfront. So we encourage people to evaluate both the industry experts as well as those that have a great track record in the process and have good relationships with you, the potential seller, and the rest of your advisory team.
Okay, so we talked a little bit about the professionals involved in the process. Now, Dave, you specialize in tax. Let's kind of transition a little bit to the structure and how the professionals play a role in that. So what kind of tax issues do you see that are important on a business sale?
Well, I see a ton of different tax issues, and a lot depends on whether it's a stock sale or an asset sale. One of the major considerations, if you're thinking about selling your company, is what type of entity you are. Are you an S Corp, a C Corp, an LLC, acting as a partnership? When you're thinking about selling your company, you want some idea of what type of buyer you're going to get, or if you're going to get some capitalization, what kind of entity is going to help capitalize your business. For example, if the most likely prospect is a large publicly traded company, they're probably going to want to use their stock as currency. And so you're going to want to make sure that your company matches up so that you can allow that transaction to happen without adverse tax consequences. If you have management or family is the most likely successor to your business, they're going to have a different strategy and certainly a different method of purchasing the business, most likely cash and debt, something like that. Bill, I put together an example that shows how important the entity selection is. I'll run through that really quickly. This is one that I had actually been through myself, and this was quite a deal. I'll set the stage. My client was an LLC. It's a partnership for tax purposes owned by individuals. We have a friendly party, which is an S corp, which has to be owned by individuals, and we have a venture fund. And they were looking at capitalizing these two companies and rolling it up. And I say friendly party S corp because my client was a consulting, and they consulted like big things like Nextel and companies like that, and that led to product sales for the S corp. And so they were very, very friendly, and they were kind of approaching this as a team. And so the proposed transaction went something like this. The venture fund is going to put in $55 million into the S corporation. And the client was going to put the individuals are going to contribute their LLC interests into the S corporation, which would become a C corporation. Fortunately, we had negotiated some chips off the table. My client got to take $12 million, the individuals, among three of them. And the S corp owners got to take $18 million. And so when we got done, the structure would look something like this. After having received the money, my client had a value of $34 million, friendly party was $48 million, and of course the venture fund put in $55 million. So my client was going to have 25% of the company, the other group was going to have 35%, and then the venture fund had 40% on a fully diluted basis, but they got preferred stock. So at the end of the day, we have the friendly party has gone from an S corp to a C corporation, and now owns 100% of my client, and has $25 million in the bank to go do their business. So, tax issues. If you contribute money or property into a corporation in exchange for stock, it's tax-free if immediately, right after the transaction, the people that contributed the property or money into the corporation own and control 80% or more of the stock of the company. In the proposed transaction, the people contributing into the friendly S corp only contributed 65%. And so that meant that the client, my clients, were going to be taxed on $34+ million of value because there was no basis in the LLC. That's over $12 million. And as you can see, going back here real quick, that's all the cash they got. And so they were not real happy with that when I told them that they're going to have to take all their cash and then some and use it to pay taxes because they had already mentally spent that money, of course. And so another tax issue here is, like I said, my client was an LLC treated as a partnership. When you sell or exchange partnership interest, it's treated as a capital gain unless the underlying property of the partnership is the kind that would be create ordinary income if it was sold and not capital gains. And that's the situation, we call that hot property. My client had hot assets. And so now he's going to have to pay taxes of 35% instead of 15%. That 20% difference over $7 million in taxes. So we had to, come up with some sort of a solution. And there was a lot of wrangling, a lot of flights to New York, and almost some fist fights over this. But we got it done, and what ended up happening is my client contributed its units into a new corporation. The S corp owners contributed their stock into the new corporation, and the venture fund contributed its money into the new corporation. And so afterwards, our guys still got their cash. They had $25 million in the new corp. The friendly party S corp is now a subsidiary, and our client is a wholly owned subsidiary. And the result, because everyone contributed their assets into a new corporation, the contributors owned 100% afterwards, which is greater than 80. Whole thing was tax-free, and all of that tax liability was saved. So it's really important to know what type of buyer you're going to have and how you're going to structure the transaction, because as you can see here, we went from a completely taxable transaction to a completely tax-free transaction, and it's just the way we structured it and using the different entities.
Okay. Any questions on that? That was quick. Let me go to the group as a whole. Any questions at this point? We have about 5 minutes left. And yes, Paul.
Steve, with respect to confidentiality agreements, in terms of even though they're legal documents binding, the fact is if the group of people are coming in into a data room and seeing the business model, seeing all this stuff. And, I mean, the fact is, essentially that the selling party has really disclosed to a potential competitor their entire business model. So, with respect to a potential seller, what advice do you have to tell them when they're looking at a sale? I mean, given the fact that a competitor can essentially steal all their pertinent business facts, what advice or how do you deal with that when you're advising your clients?
Well, there's a couple of pieces to that, Paul. First is, if it is a competitor, generally there may be a separate confidentiality agreement put into place to protect the parties, because it's important that both parties get protected in that circumstance. Second of all, until there is a term sheet in place outlining the economics and the terms and conditions, oftentimes they're non-binding, but if it's a competitive situation, you might have some kind of deposit or escrow amount in there. You only share certain information. First of all, a buyer always wants to know what's your customer concentration. That customer concentration can be customers 1 through 20 or A through Z, percentage of revenue, gross profit, those types of things. And I think, again, that's part of the reason why you put together a good team on the front end, because we understand and know from experience exactly what you should and shouldn't share, depending upon where you are in the process. And until you're at the point where you know that buyer is going to be willing to pay a price that is acceptable, you're only going to provide certain pieces of information, because, Paul, you're absolutely right. You don't want to completely undress in front of your competitor or in front of anybody that could come in and compete with you in the business until you're pretty darn certain they're going to be the buyer and you want them to be.
Let me put a little more gloss on that, in the sense that I've had situations where, companies will not allow, who have extensive dealership networks, will not allow a buyer to talk to any of the dealers unless and until they have a binding purchase agreement. Now, there may be some outs in the purchase agreement, but that, in my experience, the time in which you really have to open up your skirts completely is when you have that binding agreement that has only certain outs with it. And until that time, you've got to manage that process very carefully. It's pretty hard to avoid a pretty thorough process once you have the binding purchase agreement. But keep in mind, even if you don't have a deposit like Steve's talking about, which would be great to have, but you can't always get it. A buyer has typically invested a significant amount of their own resources to bring it to that point. And if you're comfortable that the buyer is one of integrity, I think you can probably be comfortable at that point. But I always say this to people too. I think it's important in any business, and really in any sector of business, that you are dealing with people that you know and trust and have integrity. And if you're not comfortable, you probably shouldn't be talking to them in the first place. So part of the initial dance with this acquisition is really trying to feel out and understand the people you're dealing with, and getting a sense as to whether you can trust them in this process and whether this legal agreement is going to be worth the paper it's written on or not. So.
Well, the other thing I would add is that, again, when you use a third party, it's very easy for the third party to go to the potential buyer and say, give us some examples of transactions you've completed and people we can talk to make sure, number one, it was completed as planned, but more important than that, because typically there's follow-on relationships, how did the relationship go a year or two later? And clearly it's a lot easier for a third party to ask those questions of a buyer than it is you, the seller, who's in a position where the buyer might say, well, don't you trust me? Don't we have a good enough relationship where you trust me at this point? Well, it's not about trust, it's business. It's about verification and validation of the quality of the potential buyer or buyers.
Trust but verify.
Trust but verify, absolutely.
Yeah.
Steve, you talked about some of the detriments or potential detriments of negotiating with one party, one buyer. I guess what are the benefits? What are the potential benefits of negotiating with one party from a process perspective, time and close perspective, disruption of business perspective?
Well, if you're negotiating with a party that has experience making acquisitions, and you determine that up front and you do some of that due diligence, there's no question that that can simplify and shorten the process typically. But again,